Kaeppel, Senior Market Analyst at SentimentTrader.com. It's the first day of November 2022, and in this video I'm going to give you my view of where the market is right now. Everything that I tell you is my own opinion, not that of Sentiment Trader or anybody else. So the way I see it right now, I'm basically cautiously optimistic. The reasons for cautions, as you can see, I follow a lot of different factors in the market. And what it seems to me is the big picture, the macro indicators, are all still bearish. However, at the same time, a lot of the indicators that we would use to look for a bottom or a reversal are actually turning bullish. So hence the reason I am cautiously optimistic. So let's take a look at a couple of these factors. We'll start with some of the unfavorable ones. Price action. We'll keep it as simple as possible. The S&P 500 index versus its 10-month moving average. This chart is a monthly chart that goes back to 1984. And interpretation is very simple. Above is good, below is bad. When the S&P 500 is above its 10-month moving average, it's rated as favorable. Otherwise, it's unfavorable. And here's where we are right now. We are below the 10-month moving average, so that is bad. So what we're looking for is to get back above it. Now, the thing about trend following indicators is the purpose is not precision market timing. The real purpose is to avoid riding major bear markets all the way to the bottom fully invested. For example, if we look back at the 2000 and 2008 bear markets, by moving some money, at least part of a portfolio, to cash when the S&P is below its 10-month moving average, one could have missed a lot of pain and suffering and also have had money to invest after the bottom when the market turned back up. So that's really the goal here. And right now that is unfavorable. So what we're looking for simply is for the S&P 500 to close a month above its 10-month moving average. All right, the next thing to look at is inflation. And that's been the key, the real driver so far this year in 2022 is high inflation, a 40-year high. And you can kind of see it right here. This chart looks at the 12-month rate of change in the consumer price index since 1914. You see some big spikes in inflation. You see some deflation back in the 1930s. And right now we're at about a 40-year high, a little bit off of that high. Here's what you need to know about inflation. When the 12-month change is below 4% but above minus 3%, that is what I call moderate inflation. The stock market loves moderate inflation. That's just normal. In fact, if we look at the last 30 years, we see that inflation spent most of the time in that moderate range, and during that time, not coincidentally or incoincidentally, whichever it is, the S&P gained 1,200%. So when we get above 4% or below minus 3%, in other words, too much inflation or too much deflation, that's bad. How good and how bad? Well, here's the cumulative gain for the Dow Jones Industrial Average if held only when inflation is in the moderate range. Pretty huge gain there over 108 years. And it illustrates one of the most important concepts in investing that I refer to as LLUR, which is a highly technical term, stands for lower left to upper right. That is really the goal of any investing, is to make your equity curve move from lower left to upper right. The more smooth that equity curve advances, the easier it is to continue doing what you're doing without hesitation. On the other hand, if inflation is above 4% or below minus 3%, too much inflation or too much deflation, here's the cumulative return. The Dow has actually lost 68% of its value. Now you see a huge part of that, in fact most of it, was the Great Depression, where we had deflation, which is actually, believe it or not, worse than inflation because it causes the economy to basically shut down on itself. But here we see from the early 70s into the 80s, the stock market went sideways for almost 16 years as inflation was very high. The crash of '87, the great financial crisis of 2008 were both accompanied by some inflation above 4%. And then, of course, here we are in the last year or so. Middle of last year, inflation moved above 4%. It was only a matter of time before the market reacted negatively. So what we're looking for, hoping for, is for this number to drop back down below 4%. A lot of predictions out there that it might happen sooner than later. I'm not making any predictions. I'm just following this month to month. And then what about the economy itself? A lot of gloom and doom about the economy. At Sentiment Trader, we have an indicator we call the macro index model. And you see the S&P 500 index on the top and the model itself, the blue line on the bottom. Here are the items that are used to create this indicator. And once again, interpretation is very simple. Above 0.7 is good, below 0.7 is bad. How good and how bad? Well, let's take a look. You see, this goes back to the late 1960s. When the macro index model is above 0.7, the S&P 500 has gained almost 4,900%. And when it's below 0.7, it's actually lost 28%. So once again, to kind of illustrate, let's look at the chart. When the major macro index model is above 0.7, here you see the equity curve for the S&P 500. Once again, LLUR, that's what we're looking for. And then here is when the model is below 0.7. A lot of chop, a lot of reactions. Some of the things that you would have missed by being out of the market when this model was below 0.7 include the 1969-1970 bear market, 73-74, the crash of '87, the 2000 and the 2008 bear markets, and then, of course, in the last year. So there's no guarantee the market will go down when this index is below 0.7, but you can see for yourself it definitely is a negative factor. And the current reading is 0.364, well below 0.7, so it is rated as negative right now. Again, another macro index or macro big picture item on the negative side of the ledger. Just waiting, looking for this value to get back above 0.7. Okay, let's go back to our list of factors. Right now, so far, it's been pretty much gloom and doom, but let's take a look at some of the things that we look to tell us when things are going to be possibly turning around and improving. There's an indicator we call the panic euphoria model, a sentiment indicator. On the top, you see the S&P 500 index, and below the green line, you see the index itself, the model itself. Higher readings indicate more bullish sentiment, lower readings are more bearish sentiment, and of course the thing to remember about sentiment is that is a contrary indicator. So low readings are actually bullish. And you probably know the one thing that never changes, the reason markets repeat time and again, is human nature never changes. When the market declines, as you can see in the red circles at the top, as the market declines, investors become more bearish. And you can see how well these line up. And historically, this model doesn't spend much time below minus 0.2, but when it does, it's usually an indication of better days ahead, and it's in that range right now. So we're rating that one as bullish. Okay, the next thing is breadth. And in this indicator, we're going to look at the percentage of industries in a correction. And what we do is we have 23 industries that we look at. If the industry index is 10% or more below its 52-week average, we call that in a correction. So we look at how many or what percentage of these industries are in a correction. So in this case, as the market goes down, the green line goes up because more industries are selling off. So the green line is that percentage. And what we find is that once every industry, when 100% of the industries are at least 10% off their highs, it's time to start looking for a bottom. Notice I didn't say it's an automatic buy signal. I said it's time to start looking for a bottom, and that is basically where we are now. So what you see is when the red dots accumulate on the bottom, on the green line, you can kind of see the market starts forming a bottom. Where the actual bottom comes in is, well, you have to kind of wait and see. But if we look at the far right on the top, we'll notice that in June and August and again in September, we started getting red dots. So it's time, according to this indicator, to start looking for a bottom in the market. One thing to note is not every indicator is meant as a standalone trading model. In other words, one red dot does not necessarily mean that the market is about to turn around and rally. What we see here in red is for the first 3 months after a signal, it's a little better than a coin flip in terms of the winning percentage. It's more of a get ready to buy signal. But as you can see, 6 months and a year after those signals, typically the stock market looks a whole lot better. So this is one of the reasons we want to keep an open mind about the bullish case right now. As you can see here, just a quick review of that chart. All right, the next thing is seasonality, which is simply the tendency for a market to move in a particular direction on a repetitive basis during a certain time of month or year or decade. It's a topic that's near and dear to my heart, as I wrote a book a number of years ago called Seasonal Stock Market Trends on the topic. But the one that I'm looking at right now is called the best 10 months of the election cycle. The 4-year election cycle here in the U.S. from presidential election year through presidential election year. It's 48 months, but the 10 months from October 1st of the midterm year through July 31st of the pre-election year is typically a very good period for the market. That started October 1st of this year and will run through July 31st of next year. Now let's take a look at the equity curve. Had you bought and held the S&P only during this 10-month period every 4 years, so you're invested 10 months out of every 48 months, going back to the early 30s, what do we notice about this chart? Good old-fashioned LLUR. It's a beautiful thing when it happens, right? So that's a pretty good-looking equity curve. Note that there have been 20 consecutive wins for this particular indicator going back to the late 1930s. And interestingly, we look at this year, 2022, you can see from January 1st through September 30th, it was not pretty. S&P was down 18% during the month of October. Remember, this period started October 1st. October's up 8.8%. So we call this a good start to the 10-month favorable period, and we'll see where it goes from here. But again, one more reason we want to keep an open mind about being bullish. And then one more to consider is corporate insiders. They are considered the smart money. They know the outlook for their companies better than anybody else. So when they start acting in concert, whether buying or selling, they're telling us something. Okay, so this chart, this database only goes back to about 2010, but what you see at the bottom is the buy-sell ratio for corporate insiders, and when this number starts to rise, when it gets high, as the market often is going down, they start to accumulate shares, and as you can see from the red dots, it's typically a pretty good time to follow their lead. Once again, it's not as though one dot is necessarily an automatic buy signal. In 2008, which is not shown on here, the market went down, down, down. Corporate insider buying went up, 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 even into the face of the decline. So they were quite early, but they kept buying into 2009, and about 2 to 5 years later, they were well ahead. So again, we're looking at this as a bullish indicator. Once again, not a precision timing tool, but if you take a close look at the numbers, the outlook is pretty good. Insiders are rarely wrong over a 1 to 3 year time frame. So one more bullish indicator. So here are 5 things to look for. 5 things that I'm looking for in terms of looking for confirmation that it's really time to get back in the market, because I'm not fully in the market at the moment. And some of these are kind of a review. Number 1, look for the S&P 500 to close back above its own 10-month moving average. I have no idea when that will happen. When it does, it will be, we'll switch this one over to the bullish side of the ledger. Number 2, we also looked at this one, is the Consumer Price Index. If this starts to drop quickly and gets back down below 4%, that is going to relieve a lot of pressure on the stock market. So we're going to just keep an eye on that one from month to month. Number 3, we also saw this one, our Sentiment Trader Macro Index Model, looking for that to rise back above 0.7 to tell us that the outlook for the economy has improved. Now, the last 2 were from this article that I wrote, which if you Google this, you can find it. It's a public post, not a subscriber post. And the first one is the NASDAQ high-low ratio. This indicator, each day it looks at the number of NASDAQ stocks making new highs divided by all the stocks making new highs or new lows. So it creates a ratio. And then we take the 100-day moving average, track that, and what we're looking for is a rise back above 0.29. So let's take a look. On the top, we have the NASDAQ Composite Index, the black line, and then the green line is the indicator itself, the 100-day moving average. Note that we are not trying to pick the bottom here. What we're looking for is for this to drop low and then turn around and tell us that the bottom is in. And if you look at the red dots, you can see it does a pretty good job of that anecdotally. And important thing to note, where we are right now. We're down at this low level. All we need is for these numbers to turn around a little bit, and we'll get another signal. Why would that matter? Well, here are the performance results for the NASDAQ Composite following each of those red dots that you saw on the last screen. These are fairly compelling numbers as far as I'm concerned. So keeping a close eye on this one, looking for a buy signal. And then the last one, if you want to look at the American Association of Individual Investors, AAII, the bull ratio. And it's calculated much like the last indicator. Look at the, they do a survey of their members, whatever percentage is bullish, divided by bullish plus bearish, and we keep a 20-week moving average of that, and it's the same kind of thing. We're not trying necessarily to use this to pick a bottom. We're trying to find out when the worst is over. So when this index, the 20-week average, rises back above 48%, we get a red dot. And this chart on the top, the black line, in this case, is the NASDAQ 100 index. So you can take a look at where those red dots come in. Typically, they come in at pretty decent times. Same kind of thing as before. You are here. We're down at this low level. It's going to take a little while, I would guess, for this to turn around. But eventually, it will rise back above 48%, and we will look at that as more confirmation that the market is back to being bullish. And again, why does that matter? Well, we see the numbers. Once that happens, once the worst is over and the air is cleared, we tend to get some pretty good results. So just to sum up those 5, you can see them here. The S&P 500 versus its 10-month average, the Consumer Price Index, the Macro Index Model tracking the economy itself, and then a breadth indicator and a sentiment indicator, looking for signs that the market is ready to run. And that's it. So thank you for joining me. Have a good day.